Hey yo, what's going on everyone? Welcome back to the Kung Fu Nerd channel. Welcome back to another sweet tutorial video. Today we're talking about stock option trading. This is a video I've been promising you guys, so let's just dive right in. We're talking about stock option trading, how to make money on your phone trading stock options, what that looks like, a very beginner breakdown of it. We're going to be primarily talking about trading stock options inside the Robinhood app. So if you guys don't already have the Robinhood app, you can use the link in the description to get a free $5 stock when you sign up. As soon as you deposit $10 into your account, it'll give you a free $5 stock. Sell it or keep it if you want in your portfolio. Looking right now at the basics of stock option trading. We're inside the Robinhood app. You've already signed up. You've already funded your account. The very first thing you need to make sure of is when you're signing up to make sure you put that you have some experience trading, even if you don't, because otherwise they will block you out from the option trading. They'll exclude you from it to protect you from making bad decisions and losing money. So go ahead and change your settings to say that you have experience with stock option trading. This is what you're doing basically with stock options, is you're trying to say, do I think it's going to go up? How far do I think it's going to go up? How much am I willing to risk? By what date? Or do I think it's going to go down? How much do I think it's going to go down? How much am I willing to risk? And by what date? Now, the thing is if you need a reminder, they have a really cool thing in Robinhood that shows you short-term risk, medium-term risk, long-term risk, and the amount of reward, calling it up or down. And honestly, I would say pay attention mainly just to calling it up or down. And also, one really quick thing, really important, never hit sell. Always stay on buy. Whether you're doing call or put, it doesn't matter. Always stay on buy, because you want to buy option contracts and then sell them back to the market. You don't want to sell option contracts, so don't use the sell function. Always stay on buy. You want to buy option contracts and then you want to resell them then to the market. So what does that look like? So let's say we bought this option contract. Let's say we bought this option contract and we're sitting on it and we're realizing, like, you know what? I called Apple up. Like, here's a call I made, 205 call by the end of this week, and it's not doing that good. I bought it for 35 cents. I bought one just for fun, just kind of as a demonstration for this, and it's lost 4 cents for the current option price. So I lost $4. You can see that 1% return, $4 right there. So what I can do is I can say, well, I'm going to hold on to it maybe another day and see if it's in value, or if before it loses too much money, I can go trade and I can go to sell. So if I bought this, what I would do is I would go to trade, I would go to view all options, I would go to wherever it was that I wanted to buy it. Like, here's the one I bought. So I hit this, I hit how many I want to buy, I hit review, and then once it brings it up, I swipe up and it lets me buy it. So if you want to talk about option trading, what's going to happen with an option trade? We're going to use Apple as an example because it's a clean around $200 per share. So let's say that you wanted to buy 100 shares of Apple right now because you thought it was going to go up $10 in the next week, and you were going to sell the 100 shares, make that $1,000 profit. So instead of actually having to have the $20,000, because if you were to go buy 100 shares of Apple right now, it costs you $20,000. That's just how much it costs to buy 100 shares in the market. So the basics of option trading is, instead of buying or selling these stocks at their current price, what we're doing is reserving the right to buy or sell them in the future. And the way that makes money is, let's say you think it's going to go up, you reserve the right to buy it at $200 now in the future. So if it goes up $10, you can buy it for $10 less than the market price. If you think it's going to go down, you reserve the right to sell it right now at $201. If it drops $10, you can still sell it for $201. So you can see how this is basically how you're making money, or how you're creating value. So let's go back to the option. So we're going to go look at this option 2 weeks out. We're looking at it being 30 cents to go up $10 on Apple. And this 30-cent option, if I buy one, costs me $30 because I'm buying 100 shares. I'm controlling 100 shares. So buying one option for $30 is 30 cents a contract, giving me 100 contracts or 100 shares to control. So I'm controlling a $20,000 worth of assets for $30. Now you can see how this can be very profitable and why this is super exciting, because if I call this correctly and I only risk $30, and here's the beauty of it. The thing about option trading is, if I risk this $30 and it doesn't go this direction, let's say it goes down instead it goes up, so I could lose this entire $30. So all the capital I put up to risk, I could lose it all. It could go to zero. Sure, it's only $30, but maybe instead of buying one, maybe you buy 10 and it's $300. And then all of a sudden you just lost your entire $300 because it went the opposite direction. So you can see as easily as you can make money is just how easily you can lose that same money. But here's an idea. Let's say we did buy this. Let's say not only bought one, let's say we bought 10. We felt really confident it's going to go up within the next 2 weeks or week and a half or a week. So I buy 10 of these, which reserves 1,000 shares for me to control up to 210. I'm reserving the right. If you notice at the very top, I hit July 19th. And the date before that, July 12th, that's the end of this week. So you can see it kind of goes week by week to the end of the week because that's when the market ends and closes. Now, what's interesting is, let's say I bought this and I bought it for $210 and I paid the $300. I had 10 of them. Let's say by July 19th, Apple stock is not at $210. I lose all that money. So I have up until July 19th to either execute that trade, which means that I actually want to buy all 100 or 1,000 shares at $200 instead of $210. I could execute that trade, but normally what we want to do is we want to sell this contract before that date occurs. Let's say it goes up $10 this week. This contract would all of a sudden be worth $3 per contract. We ended up paying maybe $300 for all these, but it went up to $3 per contract if it goes in the money. So we ended up making, well, about $2,700 profit from risking $300. Now that's only if it goes in the money before that date and we can actually resell it to the market. Now, if it goes inside the money during that date and the market closes above 210, Robinhood says that they'll close it out for you and sell it at market price for you an hour before market closes. But that's super risky because you're really waiting until that second the market closes and hoping it's that penny up. Because if it's a penny down, a penny below 210, you lose all of it. Now, an interesting thing to think about is like how these contracts go up in value as they move into the money. So you can see all these contracts that are below the price of the call, because we're in call right now, we're calling it up. So all this is talking about calling it up. Are all these contracts that are below the current strike price, they're in the money and they're worth way more. And if you're calling it maybe to 205 by the end of next week, you can see this $2.20 contract could move up to about $4 in value if this share price or strike price goes above it. And you can watch in real time. If the market was open, you can watch this move up and down above or below the price it's moving to. So if we look right here, we're in call. If we go to put is where we want to call it down. So if I'm thinking about this Apple stock going down below $200, I want to make a put. So before July 19th, I want to say it's going to go below $200. I could risk $200 to buy one of those. And if it goes down below $200 inside the next week and a half, this contract would go up in value because since we're calling it down, you can see the contracts that are in the money on a put are above it because you're calling it down. Here's the ones that are super, super cheap. So once you hit review, it'll just bring up a screen that says swipe up to purchase, and you just swipe up and you purchase that for $4 or whatever. I think I bought it for. I bought it for $3, and now you can see it's worth $4. So I bought 10 of these at 3 cents each. I risked $30. It went up enough to where that option, it's far enough out. Like if you go look at it, it's far enough out that I ended up buying them for pretty cheap. It's $4 up to a week and a half from now, so it might not hit that contract price. So I want to watch it and make sure it's if it's in value and I start making enough money on it, I'll probably just sell it before I wait for it to actually go all the way up to $38. But you can see I bought 10 of them for 3 cents. So I spent $30 and it's up to 4 cents each. So I made $10. So I can go trade right now. I can go to sell and I can sell all 10 of those, and it sells those accounts. If there's not enough volume in the market, it could maybe not sell for that price. It could change the price and you might need to correct it. Normally, if there's good volume in these, they sell right away at that price, and then that money goes to your Robinhood account, and you can either reinvest it back into other options, or you can then just literally send it to your bank account, and it takes like a day or two to arrive in your bank account. So it's literally crazy. It's crazy to imagine. It's hard to imagine explaining the way you'll feel the first time you make like $400 on your phone in a few minutes from a good call. So that's literally possible. Looking at this option, I bought 10 of these for 8 cents and it went up to 40 cents per contract. So making 400% return, the total $320 return. This is actually up to $1,000 return in another moment ago, but there wasn't enough volume in it, so I was planning with trying to sell it at 44 cents or 40 cents per contract. So I don't know if I'll actually be able to capture this volume, but there's plenty of examples of things I have sold, so I'll put up some of the examples on the screen really quick, and we can look through some of these, and we'll just talk about what we have as far as the examples that we can see from history, from the past, from what we've done. So this is a basic option trading video. You can go and find stocks. You can go find them in the like 100 most popular stocks, and you can look and see like where you think one's going. You think, oh man, AMD is definitely going up recently, or Ford's going down, and you can make a call or a put, putting up a little bit of money, thinking it's going to go that direction inside a certain time frame. Again, if they go to that certain time frame, like going back to Apple as an example, if we're going to go buy a contract like 2 or 3 or 4 weeks out, the further out you go to, like if the further out I go into August, the more expensive these calls are, because you have more time and more because you have more time, there's less risk. There's more of a chance it's going to go the direction you want, or it could at least head enough in that direction to where you can make money. One of the things that's interesting about option contracts is that they don't actually have to go into the option. So again, looking at the end of this week or something, let's say you think it's going to go above 2025 before the end of the week, you buy this contract for $100. This contract for $100, you buy it. Let's say it doesn't go into 2025, you lose that $100. But let's say it does go into by 202. Let's say on Friday, the share price ends above 2025. It should sell that for you at market price if you don't want to execute it. The thing is maybe you'll be able to sell it, like let's say it's in the money and it's worth maybe $2 then. So you could sell it for $220. You made $100 on it, so 100% return. That'd be great. The thing is it might go up a bunch before Friday, where maybe it goes up to 203 tomorrow. This contract will be worth more tomorrow if it goes to 203 than if you wait till Friday and it comes down a little bit and then comes up again. So the reason why is because the algorithm that projects value into the contracts is based off of the time, and well, it's based off a bunch of different things, but making sure you understand that the volatility of the stock in a single day projects a lot of value into the market or into that contract. So you want to sell it as soon as you can capture a lot of value. We don't want to sit on it. No one ever went poor from taking small gains. People go poor from chasing bigger ones. So think about that. If it's up a few dollars, if it's up $20, $50, $100, take that money. It's good to go. It's probably going to maybe come back down a little bit and then go up again, maybe, but it might not even be worth as much at the end of your option time frame. Now, another last thing, we're going to go into this in more detail in the next video. So if you guys really like this video, please like, subscribe, comment, say you want more about this. This is something we'll cover in the next video, talking about the Greeks of option trading. Now, this is a very basic video, beginner option trading for you guys, how to use the Robinhood app to trade options. This, again, is the basics of the Greeks. If you just go look at them, you can see this right here. We can go quick overview. Delta is basically like how much it goes up if it goes up $1. Gamma is like how much delta goes up if it goes up $1. Theta is how much it goes down a day. And Vega and RHO are basically useless. But we can go into that more depth in another video, talk about the algorithm and how it holds value and what creates value in these contracts. So good things to think about and things to watch. Just watching big movements, geopolitical movements, big stock trades. You can actually look inside the Robinhood app. They do a really cool job of putting up some news. So you can see recent news in the app. And interestingly enough, that you can see, the news really does affect the option price. The news really does affect the stock price. So you got to really pay attention to these and not kind of just like, you got to pay attention to these. One of the things I saw today that was interesting is like, use this as an example. This went up $15 today because of the recent acquisition that I think Cisco Systems bought Asahi Communications today for like $2.6 billion. So you can see the options. You can see these options that just happened, like the $55 call option, because it used to be down here at 40. The price was like yesterday. This option, it was probably like, who knows, a few cents maybe yesterday. It's up 12,000%. So that's 1,200x, 12,000% return on this option. So if someone had called it up to $55, above $55 yesterday, and it's above 64.7 now, they would have made so much money. You can see how much money they would have made. It's insane. They would have made basically $100 would have turned into like $120,000. I don't know if anybody's buying that right now or if they'd actually be able to sell it. for profit, but that's insane. And you can see it's not always the one that's closest up too. You can see it's not always the one that's highest up on the list. It's also sometimes the one that it's just the one that has attained the most value. So being aware of this algorithm is really like an exciting thing to be aware of. So again, this is the very basics of option trading in Robinhood app. So if you guys want a video about how to actually make money or the strategies I use, like this video, share this video, subscribe to the channel, and tell me in the comments if you want to see more of this kind of content. And otherwise, ask me questions too. I don't really know what would be questions that you guys are asking. I think I covered everything that you would need to know to jump right in and be able to start losing money or making money very quickly. So best of luck. I know there's probably a degree of you being apprehensive about losing your own money, and you should be. Don't lose money you need. Don't risk money you need to pay your bills with. But you're not going to be able to virtually simulate this. Like, you could go and play with virtual stock option trading and think you're learning how to do it, but until you're actually risking your own money and losing it, you're really not going to get a feel for what's happening. So best of luck. Let me know how that goes for you. Cheers. You're beautiful and amazing, just how you are. Have a great day.
Brought to you by your team.